another tutorial video. This time around, we're going to be looking at a deal that we've examined in some of these videos before, which is this merger slash acquisition between Men's Warehouse and Joseph A. Bank. And specifically, we're going to look at one key aspect of this deal and really any type of merger or acquisition, which is how do you determine the mix of cash, stock, and debt being used to fund an M&A deal? So here, for example, if you look at our assumptions, we're using 0% cash, 100% debt, and 0% stock. Now, technically, that's not entirely accurate because actually we do use some cash, but this cash is really coming from the combined company's balance here. So this is not entirely accurate, but the point is that this is primarily a debt-funded deal. We're using very little to no cash, and we're using no stock at all. So the question is, how do you actually decide this in real life? If you're a company acquiring another company, how do you decide which mix of cash, debt, and stock to use? And if you're a banker advising one company on an acquisition, what do you tell them? How do you make the decision about what percentage of each of these methods you use to acquire or merge with another company? This is a very common interview question, but it's also something that comes up on the job quite a bit because you will be tasked with these types of exercises and proposals in real life. So when you have a decision to make and you have to decide between a 50% debt and 50% stock deal versus a 1/3 debt, 1/3 stock, 1/3 cash deal versus a 50% cash, 50% debt deal, you have to be able to weigh the trade-offs of all those and give a proper recommendation that's based on the correct numbers and analysis. So the way you typically think about this is to look at the cost of each acquisition method, cash, stock, and debt. You want to start with the cheapest method, use everything that you can of that cheapest method, then move to the next cheapest method, and then continue like that up the ladder. So generally speaking, and I've calculated the cost of each of these different methods over here: cash, debt, and new shares issued, stock. You can see here the after-tax cost of each of these. You can see that cash is far cheaper than debt or stock, and that really lines up with the order that you use in real life. Cash is almost always the cheapest way to buy another company. Why? Because interest rates on cash tend to be far lower than interest rates on debt, which makes sense. You're generally going to earn less on your own cash and investments than you'll be paying if you have to borrow money from someone else. And then stock tends to be the most expensive because the cost of equity tends to be higher than the cost of debt. You should know that from our lessons on the DCF analysis, weighted average cost of capital, and so on and so forth. But the other factor here is that when you're assessing the cost of stock, what you're really doing here is taking the acquirer's net income and then you're dividing it by their equity value. So the equity value of 2.6 billion here. So you're really saying, okay, for each dollar we invest into this company, what is our yield on that going to be? So for each dollar of their common stock we buy, how much in net income are we getting for our money? And that yield tends to be higher than what the company would be earning on cash and what it would be paying on debt if it raises debt. So that's a little bit about how you can think about the order and the costs of each of these different components here. And I just have a summary over here that cash does tend to be the cheapest, then debt, then stock. And to compare them, you can look at this after-tax yield. For debt and cash, it's pretty easy to do this because if you look at our formulas here, we're just taking the cash interest rate times 1 minus the buyer's tax rate. And for debt, we're just taking the interest rate on debt times 1 minus the buyer's tax rate. Interest income, the company has to pay taxes on, and interest expense is tax deductible, which is why we're multiplying by 1 minus the tax rate in both cases. So based on this, and based on what most companies and what most deals look like, you're always going to start with the cash, use the most you can, then move to debt, use the most you can, and then finish up with stock. So let's go through these one by one and talk about how you can decide the most of each different option that you can actually use to fund a deal like this. With cash, sometimes it is very easy to determine this. The two easiest cases are when the company has almost no cash and they therefore cannot use anything, or when the company has a huge cash balance and they can use all of it. So if you look at a cash-rich technology company like Google or Apple, for example, they have so much cash on hand that they could probably by a good number of private startups or even a lot of other public companies, and it wouldn't even really make a dent in the huge cash reserves they have. So some companies are like that. But of course, in most other industries, in retail, for example, most companies do not actually have that much cash, and using it actually takes a lot out of them, and they therefore cannot actually use that much to fund deals like this. Now, in this case, it's pretty easy to make this determination because if we go down and look at the acquirer's balance sheet, we can see here that right before this deal was announced, they had about 59 million of cash on hand. And the problem here is that the purchase price for the seller in this M&A deal, their purchase equity value is about 1.8 billion. So think about those numbers for a second. They have 59 million worth of cash. The purchase price is 1.8 billion. Clearly, they cannot really use much cash, if any, at all to fund this deal. So this is a very easy scenario for this Men's Warehouse Joseph A. Bank deal because the buyer simply can't use much, if any, cash to do this at all. So it's pretty easy to make this determination of 0% right here. Now, of course, in real life, it tends to be harder to do this because usually what happens is something of a middle case where the company has some amount of excess cash, but maybe they don't have as much cash as Apple or Google or Facebook or another company like that with a huge cash balance that's been accumulating over the years. So what you typically have to do here is figure out what the minimum cash they need to have on hand to continue operating is, and then use any excess cash above that to fund the deal. So here's one simple example. Let's say the company has 500 million in cash right now. Its minimum cash balance that it needs to keep operating is 200 million. Therefore, you can do the math. They can use 300 million worth of cash to fund whatever acquisition or deal they're thinking of. Now, this minimum cash balance exists because all companies need to keep a certain amount on hand to fund their operations, to pay employees, to pay suppliers. It's sort of like how you may invest in the stock market. You may buy a house. You may have other types of assets, but you still need some amount of cash in your checking account to pay the bills, to pay for rent, to pay for your mortgage, to pay for utilities, and so on and so forth. Determining what this minimum cash balance is can be very tricky, but sometimes companies do disclose it, and sometimes you can also look back at historical cash balances and estimate what it might be based on that. So here, for example, they make it very easy because they filed a lot of documents related to this deal with the SEC in the US. And if you do a search for minimum in some of their filings here, they actually say directly that available cash and cash equivalents used to fund the acquisition is based on maintaining a minimum combined company pro forma cash balance of approximately $100 million. So in this case, it's very easy to figure out exactly how much cash they could use to fund the deal because they're giving us what the combined company's minimum cash balance actually is. So you can do that. Now, if you did not have something like that, you do not have that type of information, you could just simply look at their historical balance sheets and say, okay, well, historically, they've had 125, 156, 59 of cash. Maybe we can average those. Maybe we can look at the lowest one historically and use that for our minimum. So there are a lot of other ways to make an estimate here, but those are a few of the approaches that you might try. In this example, you can take a look at what we've done here for our cash, the excess cash used. Essentially, all we're doing here is we are looking at what the company's combined cash balance is right after the deal takes place, and then we're just subtracting that 100 million minimum cash balance that they mentioned. That gives us 404.8 million, but the thing is, in this case, we don't actually need to use that entire cash balance. We only need around 300 million worth of it. So that's how much we actually use in our sources and uses schedule to fund this deal. And most of this cash, by the way, comes from the seller here. So we're sort of looking at the combined company's cash balance, not just what the buyer has. So that's a little bit about cash and how you can determine how much of it you can use to fund a deal like this. Now, once you've used a certain amount of cash, maybe it's the most the company can use. Maybe, as in this example, it's used its maximum excess cash, and now it's at its minimum balance of 200 million. So now they need to think about other funding sources. How do you decide between debt and stock and which amounts you use there? Since debt tends to be cheaper than stock, you will almost always start with debt. And to determine the proper amount, the easiest thing to do is to look at the credit stats and ratios for the combined company. I have a few examples here. You can look at metrics like total debt to EBITDA, or you can look at net debt to EBITDA, or you can look at EBITDA divided by the interest expense, and try to set the level of debt such that these metrics are reasonable. What I mean by reasonable is that these should be in line with the company's historical figures and also in line with figures for comparable companies in this market. So what we've done in this merger model, for example, is at the very bottom, we actually have calculated a lot of these metrics. So we've calculated debt to EBITDA, net debt to EBITDA, EBITDA to net interest expense. We have debt to equity, debt to total capital, and a lot of other metrics down here as well. And we can see here that our total debt to EBITDA, just using this as a quick example, this goes from about 3.6x down to, it looks like around 1.7x by the end of the period. So this gives us a range over these next 5 years that we expect this debt to EBITDA ratio to be in. So what we might do here is make a guess at the amount of debt that we can use and then look at what these ratios are and then compare them to similar companies in this market. And as an example of this, let's go to equity research and just look up a couple of stats they have on comparable companies here and how much leverage they're all using. Okay, so here we go. So highly leveraged specialty retailers. If you look at debt to EBITDA here, it's around 3 to 4x to 5 or 6.5x for many of these companies. So our conclusion based on this might be that we could probably use a little bit more debt here than what we're assuming right now. So if it were necessary to use more debt, we could do so. And if the seller simply wanted us to pay more for the company and we had to use more debt to fund that, then we'd probably be okay with doing that as well. Because based on these numbers, it seems like we could probably use more in this case and still be okay in terms of our comparison to other companies in this market that are also using debt. So that's one way that you can think about this issue. So it's a bit of a trial and error process because you have to try different values for the amount of debt and see what these stats and ratios look like. As an example here, let's say that going back to our example where we use 300 million of cash to fund a deal, the company is worth 1 billion, so we need 700 million of extra funding. What we might do here is try a number like 500 million for the debt balance, and then the debt to EBITDA ratio might be 4x. Historically, the company's ratio has been around 2 to 3x, and then no peer company has a debt to EBITDA ratio of more than 3.5x. If that's the case, then we would say that 3.5x to 4x is probably the maximum here, whatever amount of debt that corresponds to. So that might be 400 million to 500 million of debt or 450 million to 500 million of debt, whatever it is, that would probably be the maximum because we are at the upper range of the peer companies, if not beyond that. And we're also well above where the company has been historically. So we'd say in this case, that might be the maximum amount of debt that we could actually use. And as I said, in this particular deal, we have debt to EBITDA and the other ratios for Men's Warehouse and Joseph A. Bank and those peer companies for both of them. So that's what goes into this. The amount of debt that you use is definitely more trial and error than the other ones, and you really have to try different values and see what the credit stats look like and then base your decision on that. Some of this also comes down to how much the company is actually paying off over time and if it can easily meet interest payments and principal repayments. If it can do that, then you might be able to use more debt and be more aggressive. But again, it depends on the specific company and their cash flow profile. So now let's move to the last option, which is using stock. Now, using stock to fund a deal is often the method of last resort, as I call it right here, because first off, it tends to be more expensive than cash or debt. And then also, most companies don't like giving up ownership to other parties and diluting their existing shareholders unless they really need to do it for some reason. So in this case, if we continue with our example, we say that we're using 300 million of cash, 500 million of debt. We're still not at that 1 billion number. We need an extra 200 million. That's going to come from stock here. So that's simply the remaining amount. We'd issue a number of shares equal to $200 million divided by the buyer's share price, and that would be our estimate for the number of shares that are issued. And that's how we would come to a number like that. Now, in this case, going back to this Men's Warehouse Joseph A. Bank example, you might look at this and say, okay, well, how do you know here that we shouldn't be using 80% debt or 90% debt and say 10% or 20% stock? What makes you so certain of this? What we would say here is that the reason you know this is because going down to look at the credit stats and ratios, all of these are pretty much well within range of the comparable companies and also where the company's been in historical years as well. So we think that it's at its current levels, we're absolutely fine using this amount of debt. Now, if we plugged in the numbers here and we got to say 5x or 6x for total debt to EBITDA, then we might have to scale that down and use more stock, 10% or 20% or 30% or something like that. So that's a bit about how you can make this determination. There isn't a real limit, technically speaking, for how much stock a company can issue. So unlike with debt or cash, where there are hard limits based on the numbers, there isn't a technical limit, but it's very unusual for a company to do a deal where they give up over 50% of ownership in their company. The only time that really happens is when you have a merger of equals, when two companies are very close in size, and then it's a little bit more expected, but otherwise you rarely see that. So again, stock tends to be the method of last resort because it's the most expensive, and you use it often when you have remaining funding for a deal and you don't have it from other sources yet. There are some exceptions. One exception is if the buyer has a very high PE multiple, then stock might actually be the cheapest method. So going back to our table up here, if the buyer had a very, very high PE multiple, let's say it had a PE multiple of 200x. Well, 1 divided by 200 is 0.5%. So it's not actually the cheapest method here, but it is the second cheapest after cash. It's actually cheaper than debt in this case. And if it were even higher, say 500x, now it's actually the cheapest or about the same as cash. So there are some of those cases where stock is actually the cheapest, but it is very, very unusual outside of industries like tech and biotech. Also, sometimes the buyer is so much bigger than the seller that it doesn't even really matter. And maybe they just want to do a deal that's tax-free, because if they issue stock, the sellers are not going to have to pay taxes on it until they actually sell their shares. A good example of this is the Google YouTube deal, where Google acquired YouTube for about $1.65 billion, paid for with stock, because Google stock is very reliable. It's not going to suddenly collapse in price or anything like that. And it was so much bigger anyway that it didn't really make a difference to their earnings. And then finally, if companies are similarly sized and they don't have any extra cash and they cannot raise any extra debt, then you might have to use stock because it's just completely implausible to use these other methods. So that's a little bit about stock. Let's do a quick recap and summary now for cash, stock, and debt in merger models. The big question here is which purchase method do you use? Do you use 100% cash, 100% stock, 100% debt? Do you use a mix of all those? It's really a more relevant question when the companies are in a closer size range. It makes a much smaller difference if the buyer is, say, 100 times bigger or 1,000 times bigger than the seller. And the way you generally decide the mix of cash, debt, and stock to use is you start with cash, you apply any excess cash above the company's minimum balance they need to keep operating. Then, if you still need extra funding, then you go to debt. And you try different values. You try to figure out what the debt to EBITDA and EBITDA to interest expense and other metrics look like. And you often try to get this into the upper end of the range for the comparable companies. Once you've done that, so let's say the upper end of the range is 4 to 5x. If you've gotten into that range and you still need extra funding beyond the cash and the debt that you've already used, then you go to stock. And this is when you start issuing shares to fund the remaining amount. Ideally, you don't want to give up 50% ownership or more, and it should be a lot less than that in most cases. But those are a few general guidelines and rules of thumb for determining this. So again, very common question in interviews, also something that comes up on the job all the time. And this is just a quick tutorial on some ways that you can think about this and make a recommendation on how to structure a merger or an acquisition.